Good morning, everyone. So today our session deals with the two standards, Ind AS 113 and Ind AS 101. Small standards from exam perspective, uh, fairly easy and scoring, and medium level importance as compared to the other standards. So in that respect, quite manageable and small standards from the perspective. Okay. So we start with Index 113. I think you would have gone through the session that was shared with you guys earlier. So I will quickly run through the key points and some questions. So we'll try to wrap up Index 113 within an hour or so. Then Index 101, let me see if I can just touch upon a couple of key points. And then we have, I suppose, professional ethics as part of today's discussion, which will spill over to the next session that is there on Saturday. Okay, so let us start Ind AS 113, fair value measurement. Very important standard because here we are having in the Ind AS regime, there are numerous references to fair value. So you have fair value references in financial instruments. You have fair value references in Ind AS 41. You have fair value references in impairment. You have fair value references in asset-based standards, liability-based standards. So it is an encompassing term that is used across the length and breadth of the Ind AS regime. So therefore, it was necessary to put a standard that defined what is fair value. Okay. So when we talk about fair value, the key point is it is a market based value. It is a market based value. It is it is market participant perspective. It should not be transaction specific or entity specific value. So that is the key takeaway from here. We are looking at the value from the perspective of the market participant. We are not interested in the transaction between two persons. So why do I have this fair value standard? I have given the explanation. There is a fair value model of accounting that we are now seeing, which is why it becomes critical to have this particular standard. Okay. Now, what is the objective of Ind AS 113? To define the term fair value. What is fair value? Set out in a single Ind AS the framework for measuring the fair value and to give the disclosures. So it applies when other Ind AS requires or permits fair value measurement. Example, Ind AS 109. Ind AS 109 talks about fair value. The fair value referred there, how do I measure it? For that, you will have to come to Ind AS 113. There are certain exceptions to the applicability. Measurement and disclosure, both measurement as well as disclosure. In AS 102, we have the measurement that is taken care of there. And leases, we have in AS 116, which takes care of the measurement. And certain uh, terms which we use, like for example, net realizable value or value in use, all of them appear to be similar to fair value, but they are not. So in these three cases, you do not have measurement as well as disclosure applicable to these points. Whereas in the case of two standards, only disclosures are not applicable, but measurement principles of 113 continue to apply. That is Ind AS 19, as well as assets for which recoverable amount is fair value less cost of disposal in AS 36. So this is the scope and objective of Ind AS 113. So coming to the main, the whole crux of today's discussion, what is fair value? So it is a very beautiful definition that is there in the standard. It is a price that is received on sale or on sale of an asset, or the price that would be paid to transfer a liability. So it is a price that would be received on selling an asset, or the price that would be paid to transfer a liability. I'm not settling the liability, I'm transferring the liability in a transaction in an appropriate market, in an orderly transaction in the appropriate market between market participants, and this is measured at something known as the measurement date. So we are having five key parameters. First one is it is price. Second is it is appropriate market. Third one is an orderly transaction. Fourth one, it is between market participants. And fifth one, it is at the measurement date. So if we briefly run on through these five limbs of the definition, when we talk about price, it is clearly stating that it is an exit price. How do I know it is an exit price? It is the price received on selling an asset or the price paid to transfer a liability. I'm not settling the liability, I'm transferring the liability. I have a debenture, you need the money, so I transfer this debenture to you. So when I transfer the debenture to you, I will pay the amount also along with that to you. Is the debenture getting extinguished? No. The debenture holder, instead of coming to me, will come to you to claim the proceeds at the time of maturity. So that the liability is only transferred from person A to person B, and that is the exit price. So how much do I have to pay to transfer, or how much do I have to receive to transfer an asset? So that is the meaning of price. So when we talk about price, it means the exit price. It means the exit price. And in which transaction? In an orderly transaction. Orderly transaction means what? Orderly transaction means in a transaction that is without any bias, in a transaction without any bias, in a transaction that is free, that is without any of those what you say, any of those uh, terms in the contract which make it voidable, like coercion, fraud, etc. Okay, so that is the meaning of an orderly transaction. Price that is typically based on transactions in the vicinity, in the surrounding, what is the price that you are. Okay, so this is an orderly transaction. Measurement date, it is always at a particular measurement date, because if I'm doing fair valuation of my financial instruments, I have to do it at the reporting date. So that is the meaning of measurement date. In a transaction in an appropriate market, in an appropriate market. So now coming to appropriate market, what do we mean by appropriate market? Okay, let us run through the understandings of appropriate market. There are two markets. First one is the principal market. Second is the most advantageous market. Preference will be given to the principal market. If principal market is not available, then we look at the most advantageous market. So what is your principal market? It is the market that has the highest number of buyers and sellers. It is a market which normally the place in which assets and liabilities are being transacted with highest volume, with high level of activities compared to any other market available for similar transaction. So market that has highest number of buyers, highest number of sellers, highest number of activities as compared to any other market for the commodity in question. So why does it become important? Because in such a market setup, a single buyer or seller cannot influence the market, because it is a perfect competition. It is a perfect competition. A single buyer or a single seller cannot influence the market, number one. Second is the buyers and sellers are both knowledgeable, and therefore the price will always tend to the fair value. The price that both of them agree will always tend to the fair value, will always move towards the fair value. And that is why, if for a commodity principal market exists, you will consider the principal market for fair value measurement, even if other markets are more advantageous. Suppose you do not have a principal market, you will move to look at the most advantageous market. What do you understand by the most advantageous market? The most advantageous market means the market which maximizes the amount that would be received. That means I will obviously sell my product in a market where my returns are maximized, where the net proceeds are maximized. So what do you mean by net proceeds? Net proceeds means available price, what is there, minus the transportation cost, the cost to reach that particular market, minus the transaction cost. So that is your net proceeds. So the market which maximizes the net proceeds becomes your most advantageous market. And that is exactly what you will consider for the purposes of fair value measurement if the principal market does not exist. If principal market exists, then you will not look at the most advantageous market. Are we okay with this so far? Yes, are we okay? Any doubts? No doubts? Yes. Kushi, good morning. Manish Gupta, good morning. Yes. Yeah, tell me. No doubts? Okay. So then let us proceed further. So principal market, most advantageous market. Okay. So you have these two small examples. Go through them for homework. Okay. We'll look at a couple of questions shortly. So coming to, so it is a transaction. Ultimately, we saw how many parts of the definition? I think we saw four parts of the definition, right? Yeah, so the last part is market participants. What do you mean by market participants? The parties which eventually transact the assets or liabilities either in the principal market or the most advantageous market in their best economic interest. So they are going to look at investment, they are going to look at selling their product in the best economic interest. So when we talk about market participants, typically they are independent and not related parties. If they are related parties, they have done the transaction at arm's length. Should not be under any stress or force, and they should have reasonable and sufficient information about the same. So this is broadly what categorizes the definition of fair value. Okay. So coming to what, how do I calculate fair value? How do I calculate fair value? So fair value is nothing but available price minus transportation cost. For most advantageous market, we look at net proceeds. Net proceeds is available price minus transportation minus transaction cost. But the transaction cost here, that transaction cost is transaction specific. It becomes entity specific. Whereas for the purpose of fair valuation, we have to consider only from the market perspective, not entity specific cost. And therefore, we exclude the transaction cost and we say that fair value equal to available price less the transportation cost. So this is the definition of fair value that you will take away from today's session. Okay. If I deduct the transaction cost, it becomes net realizable value. It becomes net realizable value. The transportation cost is not entity specific. Answer is no. It is commodity specific. It is the cost that changes the characteristic of the product in terms of its location. So location moves from existing place to either the principal market or most advantageous market, and therefore you are changing the location. Therefore, you are changing the location. Changing the location means changing the feature of the asset, changing the characteristic of the asset. And therefore, you are deducting it from the available price to arrive at fair value. Are we okay with this? Yes, are we okay? Manish, any doubts? Anybody has any doubts? Any doubts? Yeah, no doubt. Okay, fine. So let us proceed. So that is the definition of fair value. We have covered the definition. Okay, all right. Now let us come to one of the questions. This is taken from your study material. An asset is sold in two different active markets at different prices. An entity enters into the transaction in both the markets and can access the price in those markets for the assets at measurement date. In market A, the price that would be received is 26. Transaction cost is 3. Cost to transport the asset to that market is 2. So market A, available price, transport and transaction. Okay. So market A, price that would be received is 26, transaction cost is 3, and cost to transport is 2. Okay. In the case of B, the price that would be received is 25, transaction cost is 1, and transportation cost is 2. All right. So now you are required to calculate the fair value if market A is the principal market. Okay. If market A is the principal market, will I look at market B? Answer is no. You will not look at market B. So therefore, what will be your fair value? Available price minus transportation cost. So 26 minus 2 is equal to 24. This is the answer to 1. Answer to 2. If none of the market is a principal market, we will look at the most advantageous market. So 26 minus 2, 24 minus 3, 21. 25 minus 2, 23 minus 1, 22. So which becomes most advantageous? B becomes most advantageous. So 25 minus 2 equal to 23. Yes. So this is your solution. Okay, let us just check the answer. Yeah, so there you go. We have seen this fair value will be 24. In our case also fair value was 24, case 1. Case 2, most advantageous market using the price in market B, and that comes to 23. Is it coming to 23? Answer is yes. Are we okay with this? Yes. Are we okay? Fine. All right. So just go through this for homework. You have to identify the most advantageous market in this case. Okay, all right, fine. Now that is the easy part of it. That is the easy part of it. All right. Now the problem is coming to non-financial assets valuation. See, financial assets is pretty simple because they are assets held for the purpose of getting cash. So you can easily value them. But the problem is with non-financial assets because there are multiple uses. There are multiple uses. I am really not sure what is the use that I am going to do with it. Okay. So therefore, as an owner of an asset, what are you going to do? If you want to do business, you will look for the avenues which maximizes your value, which maximizes your value. So we call it as the highest and best use concept. Highest and best use concept. So what do you mean by highest and best use concept? This is applicable only for non-financial assets. Financial assets, they have single use. Either you earn interest or dividends or capital appreciation. That's it. Only these three things. But for non-financial assets, suppose you have a plot of land. What can you do? You can leave it idle. Number one, you can put it out as a parking space. Number two, you can construct your office on that. Number three, number four, you can give it to a developer and you can get some flats and shops and he can make the building for his profit. So that is number four. Then you can set up a resort on that. Number five, it could be used as an amusement park if it is big enough. So the usages are various. The usages are various. You can make a case study. You will find 15, 20, 30 uses also possible. The question is, which am I going to use? Which am I going to use? So what you are going to do is the one that gives you the best value out of it. You are going to do. Now, when we talk about highest and best use, it comes with three major caveats or three major points. What is that? The first one is it must be physically possible. The second one is it should be legally permissible, and the third one is financially feasible. So before you jump as to what becomes a highest and best use concept, you will look at is that particular use physically possible? Can you do that? Is it legally permitted? And last one is it feasible financially? If these three things are met, you can say that the choice that you have selected indeed becomes the highest and best use. Now, this is from the perspective of a market participant. Again, this is from the perspective of a market participant. One has to identify the market participants and then find the best legitimate use of this non-financial asset. Again, if there is any restriction specific to a market participant, then those restrictions will not be considered. Restrictions specific to market participants would not be considered. Suppose you are an entity and you only have a license to construct residential complexes. You are not entitled to construct commercial complex. But on the plot of land that you own, commercial complex also can be built. So now I have a restriction not to build a commercial complex. But can somebody else build it? Answer is yes. And therefore, when I am determining the valuation of this land, I obviously have to consider the fact that the highest and best use is not what I am doing. Highest and best use is in fact the construction of commercial complex, and therefore the valuation of the land will be done on the basis of that premise. Okay. In absence of potential best use, which is not easily available, current use would be considered the best use. Current use would be considered the best use. And last part, while considering fair value under an alternative use, deduct the estimated cost to be incurred in order to make the asset ready for alternative use. Okay. So you deduct the estimated cost, make the asset ready for alternative use. So suppose you have some plot of land on which there is some old building. You want to construct a commercial complex. So the cost of demolition of that old building will be deducted to arrive at the fair value. Are we okay with this? Yes. Are we okay? Any doubt? Any doubts? No doubts. Shall we proceed further? Yeah, all right, fine. Okay. So now let us look at couple of examples on this. Entity bought some land intended to be used for business purpose. However, entity now wants to sell this piece of land at fair value. So one has to evaluate all the possible uses of this land before determining the fair value. This land could be used to make a commercial place, which could be more in value as compared to when it is used for business purposes. The commercial place value would be considered the highest and best use, if obviously the same is allowed in its locations and conditions. Is it okay? Yes, something which we have already seen. Okay. Coming to the next example, A acquires a machine in a business combination by acquiring controlling stake in B. So business combination hua, and under that you got the machinery. The machine will be held and used in A's operations. It was originally purchased by B from an outside vendor, and before the business combination was customized by B Limited for use in its operation, but the customization was not extensive. A determines that the asset would provide maximum value to market participants through its use in combination with other assets or with other assets and liabilities as installed or configured for use. No evidence to suggest that the current use of machine is not its highest and best use, and therefore current use itself is its highest and best use. So many times what happens is the standard gives you the understanding that, look, you need not go for a very big research. Okay. You are a prudent businessman, and therefore what you are doing currently with the plot, with the asset, we will take that only to be highest and best use. We will not consider anything else. Okay. So that makes it pretty much reasonable and simple from an understanding perspective. Okay, so in this case, what they are saying, he wants to use this asset in combination with other assets or other net assets, assets and liabilities put together. And therefore, that use itself will be the highest and best use. That use itself will be the highest and best use. Okay, so example 12 is done. All right. Now, potential use. So A Limited owns a property which comprises land with an old warehouse on it. It has been determined that the land could be redeveloped into a leisure park. The land's market value would be higher if redeveloped. Okay. A Limited is unclear about the investment property's fair value, whether it should be based on market value of property under current use or the potential market value if the redevelopment occurred. So therefore, they are still thinking कि भाई fair value क्या होगा. So now you tell me, will you base it considering the current use, that is just owning a property, or will you consider it in the potential use of that of a leisure park? What do you think? What do you think? Obviously, the leisure park has a higher value, so that will be the basis. So the property's fair value should be based on the land's market value for potential use. The property's existing use value is not the only basis considered. Fair value is highest value determined from market evidence by considering any other use that is physically possible, legally permissible, and financially feasible. Okay. So highest and best use assumes that there is a redevelopment of the site, which will involve demolishing the current warehouse and constructing a leisure park in its place. Therefore, none of the market value obtained for the land is to be allocated to the building. So market value of current building on the property's highest and best use as a warehouse is zero. It is nil. And as a result, the building's carrying amount should be written down to zero. Are we able to understand? Yes, are we able to understand? Any doubts? Any doubts? No doubts? Okay, so let's proceed further. Coming to question number 2. J acquires land in a business combination. Currently, it is developed for industrial use as a factory site. Although the land's current use is presumed to be its highest and best use, unless market or other factors suggest a different use, J considers the fact that nearby sites have recently been developed for residential use as high-rise apartment buildings. On the basis of that development and recent zoning and other changes to facilitate that development, J determines that the land currently used as a factory site could be developed as a residential site, and that the market participants would take into account the potential to develop the site for residential use when pricing the land. What is the highest and best use of the land? What do you think? Quick answer. Yes. Answer, please. Answer, please. Yeah. What do you think? Currently, it has land which is used as a factory, but it is seeing a potential use as a residential site. And the company believes that in valuation, they will consider the expected use as a residential complex construction site. So what will be the highest and best use? Obviously, the alternative. Obviously, the alternative. Okay, so that takes care of question number 2. Okay, fairly simple, not difficult. Okay, all right. So we can look at the solution. This was which question? Question 2. Okay. The highest and best use is determined by comparing the following: value of the land as currently developed for industrial use and the value of the land as a vacant site for residential use, where you would consider the risk and uncertainties about whether the entity would be able to convert the asset into the alternative use. Okay. The highest and best use of the land would be determined on the basis of higher of these values, obviously. In situations involving real estate appraisal, determination of highest and best use might take into account factors relating to the entity's operations as well as its assets and liabilities, which is a standard practice. Okay, so this is your conclusion. So that is answer to question 2. Coming to question 6.1. DS owns some vacant land for which the use is not yet determined. Okay. The land is situated in a prominent area where a lot of commercial complexes are coming up, and there is no legal restriction to convert the land into a commercial land. The company is not interested in developing the land to a commercial complex as it is not its business objective. Currently, the land has been let out as a parking lot for the commercial complexes around. The company has classified the above property as investment property. In days 40, the fair value disclosure is required. It has approached you to obtain fair value of the land for the purpose of disclosure under Ind AS. On what basis will the land be fair valued under Ind AS? Okay. On what basis will the land be fair valued under Ind AS? Okay. So now question 6. So when you are doing the fair valuation of a non-financial asset, you would typically consider the highest and best use. Okay, you would typically consider a fair value measurement takes into account a market participant's ability to generate economic benefits by using the asset in its highest and best use, or by selling it to another market participant who could use the asset in its highest and best use. So the key principle is clear. It considers three things. The first one is whether it is physically possible, legally permitted, and financially feasible. Okay. Highest and best use determined from the perspective of market participants, even if entity intends a different use. See, they have written in the question specifically that the company is not interested in developing it into a commercial complex. But that is the company's choice. That is not the market participant's choice. Okay. However, an entity's current use of a non-financial asset is presumed to be its highest and best use, unless market or other factors suggest that there are alternative uses that can maximize the value of the asset. To protect its competitive position or for other reasons, an entity may intend not to use an acquired non-financial asset actively, or it may intend to use the asset according to its highest and best use. Okay, so that is all theory. In the given case, highest best possible use is to develop a commercial complex. Although it is against the business objective of the entity, it does not affect the basis of fair valuation because Ind AS 113 is not considering entity specific restrictions or objectives. Rather, it is more of a market based approach. So therefore, the also the current use as a parking lot is not the highest and best use, as the land has the potential for building a commercial complex. Fair enough. And that is why the fair value of the land is the price that would be received when sold to a market participant who is interested in developing the commercial complex. Who is interested in developing the commercial complex. Are we okay with this? Yes. Are we okay? Anybody has any doubts? Anybody has any doubts on this part? No doubts. Manish, समझ में आ गया? Yes. All clear? I hope it's all clear. All right, fine. So let us proceed to the next. Uh, let us proceed to the next part. So when we talk about fair valuation हो गया, we understood what is the meaning of fair value. How do we do it for non-financial assets? Financial assets is pretty simple because I know what will be the fair value. I know the inflows that will happen. We could do a DCF for a market-based valuation. So it is pretty simple. We will see financial assets, one or two examples we will see, but there the complexities in the manner of valuation arise in the method of valuation, whereas here the premise of valuation itself is different. Okay, so now coming to your valuation techniques, the objective is to estimate a price, that is quoted prices are not available in the principal or most advantageous market. So we estimate the price at which an orderly transaction would take place between market participants at the measurement date under current market conditions. So entities shall use valuation techniques that are appropriate in the circumstances and for which sufficient data is available to measure the fair value, maximizing the use of relevant observable inputs, minimizing the use of unobservable inputs. So there are two categories of inputs. First one is observable, second one is unobservable. So when we talk about observable inputs, these are the inputs which I can see and implement straight away to my particular, what you can say, to my particular case. Unobservable inputs means they are your estimates, they are your assumptions. And therefore, a valuation technique makes use of both these inputs, observable as well as unobservable. Which one should you prefer? Obviously, I will prefer that method, that input, where bias is the least, where my, what you can say, where estimations are minimal, where assumptions are minimal, where you are having your objectivity maximized. So if you look at observable inputs, you can straight away put that as the value. You can straight away put that as the value. Are we okay with this? Yes. So the rule is maximize use of observable inputs, minimize the use of unobservable inputs. So what do you mean by observable input? Suppose you have 1 gram of gold and you want to do a fair valuation of it. What will be the basis of valuation? Sir, I can go to the gold exchange and look at the price, and that becomes the value as on that particular date becomes the value, becomes the value. Are we okay with this? Yes. So that is how it is known as, that is how it is known as the observable input. Okay. Data based on market data obtained from independent sources. Example, share prices on BSE or gold rate on the commodity exchange. So it is objective. Whereas unobservable inputs based on entities' own assumptions about financial factors. Like for example, projected future cash flows. Highly subjective, lot of assumptions. Bias is inherent. Bias is inherent. So therefore, you maximize this and you minimize the usage of unobservable inputs. Okay. So what are your inputs? They are categorized into three levels. The first one is level one inputs. Level one inputs means quoted prices in active markets. Quoted prices in active markets for identical assets or liabilities. You have 1 gram gold, you go to the commodity exchange and look at gold price 24 carat, 24 carat bas ho gaya. That becomes the price of the gold. So the input that I used is the price of gold on the commodity exchange. Did I do any adjustment to it? Answer is no. And therefore, we call it as a level one input. We call it as a level one input. That means you are just taking the value without any bias. Without any bias. So this is your level one input. Coming to level two inputs. Inputs other than quoted prices. Inputs other than quoted prices. For example, you are having 18 karat gold, but the market has prices of only 22 karat or 24 karat gold. So if that is the case, how do I do the valuation? The valuation will be, we take the 22 or 24 karat gold market price, and basis that I determine the value of the 18 karat gold that I am having with me currently. Another example, suppose you are owning a share of Hyundai Motor India Private Limited and you want to value the share. What do? You probably look at the market value of Maruti Suzuki share, because that is the entity that is having similar operations and similar is the customer base also. So therefore, you take the valuation of you take the market price of Maruti Limited shares. But can you apply the same value to the value of Hyundai? Answer is no. You will have to do some adjustments. Like for example, liquidity discount has to be applied because Hyundai is not a traded entity. So like that, you have multiple situations. Like that, you will have multiple things that need to be adjusted. But it is still better than totally unobservable inputs, because you are taking the observable input and doing some small adjustments, So these are include quoted prices for similar assets or liabilities. In this case, it is identical asset. In level one case, identical assets and liabilities. Level two, it is similar assets and liabilities. For example, entity holding 21 karat gold, whereas price of 24 karat is only available. Price of uh, 24 karat only is available. So how are you going to do? Well, you take the 24 karat and then you do simple calculation to arrive at 21 karat gold. Are we okay with this? Yes. Any doubts? No doubts. Coming to level 3, unobservable inputs for the asset or liability which reflect the assumptions of the market participants would use when pricing the asset or liability. So this is very subjective. It is very subjective. Like for example, financial forecast, historical volatility required for valuing options under the Black and Scholes model, etc. So level 3, nothing is there in the market. You yourself have to pick up the value. So level 1 input, market price hai, take that only, and you are currently at identical assets or liabilities. So that is the level 1. Level 2, we take available prices, do some small adjustments. Level 3, totally subjective, purely based on your assumptions. There is a high chance of bias, and therefore uh, you will be pretty careful with level 3. You will be pretty careful with level 3. Are we okay with this? Yes. Any doubts? No doubts. So level 1, level 2, level 3. Kushi, are you following beta? Okay, fine. Manish has confirmed. All right. Continuing the sixth question, DS holds equity shares of a private company. To determine fair value of the shares, company uses DCF method as there were no similar shares available in the market. Under which level of fair value hierarchy will the above inputs be classified? If the quoted price of similar companies were available and can be used for fair valuation of the shares. Tell me, what do you guys think? Just give me a minute. Read the question and answer. Yes. It holds equity shares of a private company. To determine the fair value of shares, the company used DCF method as there were no similar shares. What is DCF? You are estimating the future cash flows. Future cash flows means you will do an estimate of how much the sales will happen, what will be the material margins, what will be the labor cost in future. So this goes for 3 to 5 years, 7 years, 10 years, etc. So you will do this valuation. You will do these assumptions. You will then make an assumption of the discount rate, then you will discount it to the present value and determine. So tell me, is this a level 1 input जहां पे आपने value देखा और डाल दिया, or is this a level 3 input where there are lot of assumptions and biases involved? First question, under which level will the above inputs be classified? Clearly this will be level 3. Clearly this will be level 3. It falls under level 3 of fair value hierarchy. Okay. Unobservable inputs shall be used to measure fair value to the extent observable inputs are not available. The unobservable input shall reflect the assumptions that market participants would use when pricing the asset or liability. In the given shares, DS Limited adopted DCF method, commonly used technique to value shares, and hence it follows under level 3 of the fair value hierarchy. Manish, समझ में आ गया? Yes, it's not level 1, it's level 3. Level 2 inputs. Okay, so coming next to the question, what will be your answer if the quoted prices of similar companies were available? Then you can take those values, but you will have to do some adjustments. You will have to do some adjustments. Okay. Level 2 inputs include the following: quoted prices for similar assets, quoted prices for identical or similar assets in markets that are not active, in markets that are active, inputs other than quoted prices are observable for the asset or liability. If an entity can access quoted price in active markets for identical assets or liabilities of similar companies, which can be used for fair valuation of the shares without any adjustment, then it will be considered as an observable input and would be considered as level 2 inputs. Are we okay with this? So what will be your answer? This will be level 2. This will be level 1. Are we okay with this? Yes, are we okay? Yeah, all right. So question 6 is done. Okay. If an observable input requires an adjustment using an unobservable input, and that adjustment results in a significantly higher or lower fair value measurement, then the resulting measurement would be categorized within level 3 of the fair value hierarchy. Okay, all right. So what we are saying is you are having an observable input, but to that observable input, you have to do some adjustment, and that adjustment gives you a very high or very low fair value measure because you are ultimately putting in what is suitable to you. So you have the observable inputs plus specific adjustments minus any specific adjustments to give you the fair value, to give you the fair value. Okay, so now if this fair value and that observable input there is a lot of difference, then even though we are using observable input and some small adjustments, it continues to be a level 3 hierarchy. We cannot call it as level 2. Okay, we cannot call it as level 2. Are we okay with this? Yes. So ये वही example है. You can go through it. Okay. All right. Go through these questions by yourself. Okay. All right. Fine. Sometimes we will have to do some adjustments to quoted price when it does not reflect the fair price. Like for example, you have uh, made a bid. You have made a bid for a project. For a project. Now the bids are open. The bids will open at 6 p.m. The bids will open at 6 p.m. and the markets close at 3:30 p.m. The markets close at 3:30 p.m. Now, when the markets close at 3:30 p.m., clearly any special event that happens after that day, the impact of that we will see in the market only the next day. So now, suppose this is a very huge contract. We have received that bid because we quoted pretty competitively. And of course, the track record that was there that we have maintained is good among the prospective customers. So therefore, when they opened the bid, it was evening 6 p.m., 31st March. Now, at 3:30 p.m., I had the shares and I was not aware of this bid. So closing rate, you have suppose 500 rupees value. But the fact that I won the bid will jack up my prices and I know these prices the very next day. So my share of 500 is now getting traded at 850 rupees. Why? Because of the bid that I won. Because of the bid that I won. And therefore, what value will you consider for financial reporting? Will you consider number one, what value are you going to consider for your valuation? Yeah, tell me. Will you consider valuation at closing of 31st March? Number one. Will you consider opening valuation given that the bid was processed the previous day? Number two. Yes, what are you going to do? Yes, 500 has become 850. Clearly, you have to show 850. You have to show 850. Problem is, how can you show 850? Yes or no? Because as at closing, the price is only 500. Tomorrow it is 850. So that is where the standard says, in certain cases, a quoted market price in an active market might not faithfully represent the fair value of the asset or liability, such as when significant uh, events occur after the measurement date, but occur on the measurement date, but after the closure of trading. In these situations, just adjust the quoted price to incorporate this new information into the fair value measure. Okay. If the quoted price is adjusted, resulting fair value would no longer be considered a level 1 measure. Would no longer be considered a level 1 measure. Companies' valuation policies and procedures should address how these after R events will be identified and assessed. Control should be put in place to ensure that any adjustments made to quoted prices are appropriate and are applied in a consistent manner. So this cannot be a level 1 input any longer. Are we okay with this? Yes. So go through this for homework, same as what we discussed. Okay, same as what we discussed. Any doubt? Any doubts? No doubts. Okay, fine. So let us proceed. Valuation techniques or approach to valuation. So there are three approaches. First one is market approach, where you take the market price and do the valuation. Number two, income approach, like the DCF method. So you would have to assume the cash flows, you would have to assume the discount rate. All these are what are going to be your assumptions. And finally, the cost or asset approach, that is the net asset value method. Are we okay with this? Yes. So valuation approach should be consistently followed. If there is change in valuation approach, it shall be treated as a change in accounting estimate as per Ind AS 8. As per Ind AS 8. That is disclose the reason for such change. So market approach, income approach, cost or asset approach. Yes. Did you follow? Any doubts so far, students? Any doubts? No doubts. Okay. So let us proceed further. Discount rate assessment to measure present value. Okay. All right. So let us look at this. We have some. Okay. Discount rate assessment to measure present value. Investment one is a contractual right to receive 100 in 1 year, 800 in 1 year. There is an established market for comparable assets. Information about those assets, including price information, is available. Of those comparable assets, investment two is a contractual right to receive 1200 in 1 year. Investment three is a contractual right to receive 700 in 2 years and has a market price of 566. The first one is 1083. All three assets are comparable with respect to risk, that is dispersion of possible payoffs and credit. You are required to measure the fair value of asset one basis the above information. Okay. So I have two investments. One that gives me a return within 1 year, another that gives me a return within 2 years. So obviously, what will I prefer for valuation? The one that gives me the return within the first year, within year. Okay, I mean within year 1 to 2. Okay, so therefore, how do I do the valuation? So therefore, investment to fair value equals 1083, contractual cash flow 1200. So IRR is equal to, you get the IRR of 10.8%, and therefore value of your investment. Therefore, value of your investment. Yes. Yes, did we follow? Yeah, did we understand? Yes, all right, fine. Coming to the next one. Okay, just a minute. Okay, this one you can do it for homework. ABC Limited acquired 5% equity shares of XYZ Limited for 10 crores in the year X1, X2. Company is in the process of preparing the financial statements for the year X2, X3, and is assessing the fair value at subsequent measurement of the investment made in XYZ Limited. Assessing the fair value at subsequent measurement of the investment. Okay. Based on the observable input, the ABC Limited identified a similar nature of transaction in which PQR Limited acquired 80% equity shares in XYZ for rupees 60 crores. The price of such transaction was determined on the basis of comparable companies method, that is EV/EBITDA, which was 8. For the current year, EBITDA of XYZ is 40 crores. At the time of acquisition, the valuation was determined after considering 5% liquidity discount, 5% NCI discount. What will be the fair value of ABC Limited's investment as on the balance sheet date? Go through this question again. Go through this question. Yes. Tell me, how are you going to solve this? Yes. What is happening here? Can anybody summarize and tell? Manish? Okay, so let us do it. So we have to do it using comparables method. We have to do it using comparables method. Now, how do I do that? Okay, so let us understand. So comparable, I have the solution for you. Yeah, this is the one, right? Yes, that's not. Okay. In the given case, valuation of 5% equity shares in XYZ is done based on comparable companies approach. The comparable transaction being PQR acquiring 20% equity shares in XYZ for 60 crores. Let us understand what is happening. EV/EBITDA that is given is 8. Already this is of the comparable transaction. This is the comparable transaction. Okay. Therefore, enterprise value is equal divided by 40. EBITDA of XYZ PQR transaction equal to 8. Therefore, enterprise value of XYZ is equal to 320 crores. Now, we will now have to apply this value after considering factors for ABC. क्या factors है? See, enterprise value is 320, but ABC stake is only 5%. So 320 into 5% is 16. Less liquidity discount 5%, less 5% NCI discount. So that gives you 14.4. That gives you 14.4. What do you mean by liquidity discount? Generally applied if the stake held is illiquid. Number one. Number two, non-controlling discount. Non-controlling discount. Okay. Yes. Are we okay with the calculation? Yes. Are we okay with the working? Manish, समझ में आ गया? See, enterprise value. See, this is a multiple. This data is given to you in the question. Okay, you can see the question. The price of such transaction was determined on the basis of comparable companies method. Which method are they using? Enterprise value EV divided by EBITDA, which was 8. So what is your EV? This is the total value of the enterprise. This is the total value of the enterprise. Okay. So your enterprise value EV EBITDA is 8. This is the multiple. We have calculated your EBITDA. So therefore, from there, what are we going to expect in terms of enterprise value? 8 into 40, 320. But 320 is for the entire enterprise of 100%. मेरा शेयर कितना है? My share is only 5%. So that becomes 16 crores. And then you are having liquidity discount of 5% and NCI discount of 5%. So that goes down and brings the fair value of investment in XYZ Limited. Are we okay with enterprise value? Yes. Yep. Okay, fine. So that takes care of this question. Okay. You can go through these questions. They are more on your financial management side. Okay. All right. Yes. Can you try this question for homework? I'll share the solution with you on the portal. You can verify that. Okay. All right. Same goes for this also. All right. So please do those questions for homework. They are simple questions, but slightly typical in the sense they have your financial management concepts also flowing in. Okay. Coming next, applying fair value rules to liabilities and own equities. Liabilities to hona hi chahiye. We did whatever questions came from the perspective they were our assets. But if they are our liabilities, then also you will have to do the same thing. Yes. So, assumption made while carrying out fair value measurement is transferred to the liability and or equity instrument so transferred will remain outstanding on the date of measurement. Will remain outstanding on the date of measurement. Yes. Assumption is they are transferred to a market participants. They will remain outstanding on the date of measurement. So use all observable inputs, maximize observable inputs, minimize unobservable inputs. The transaction considered to find fair value should be evaluated in line with the orderly transaction, not entity specific. Okay, so fairly simple. All right, so go through this for homework. It is just an example that tells what do they mean by transfer of a liability and how do I do the fair value. Okay. How do I do the fair value? Okay. All right. So your liability and or equity instruments of the entity, if they are held by other parties as assets, if they are held by other parties as assets, like for example, you have a loan, it is held as an asset from the perspective of the lender, from the perspective of the lender. So if it is measured as an asset, then for us also you can take those what you can say, you can take that level one input quoted prices because it is actively quoted. If coming to the next one, if quoted price not available, you can look for price of similar. You can look for price for similar items instead of instead of directly price is getting available, you can make some adjustments. If one and two are not available, then you will have to go in for a valuation technique using income or market approach. Yes, are we okay? Sometimes the liabilities are not held as assets by counterparties. Okay, the liabilities are not held by counterparties as assets. So this could be like, for example, decommissioning liabilities or provision for what you can say, provision for expenses, etc. We don't have a corresponding party, so we have to record the what you can say, you will have to record the valuation. So how will you do the valuation? You will measure using a valuation technique from the perspective of a market participant that owes the liability or has issued the claim on equity. Are we able to follow? Yes. All right. So when we talk about fair value rules to liability and own equity, we assume transfer and not settlement of a liability or own equity instrument. If there is a quoted price, use the quoted price. If no quoted price, is there an identical item held as an asset by another company? Answer is yes. So that is one. Coming to the next one, is there identical item held as asset by another party? If the answer is no, then we are going to use a valuation technique. Then we are going to use a valuation technique. Okay. All right. So now let us understand this with the help of an example. Let us understand this with the help of an example. X and Y enter into a contractual obligation to pay 500 in cash to D in 5 years. Is this the liability for X? Answer is yes. Is this the liability for Y? Answer is yes. So now we have to do the fair valuation of this liability. X is having a double A credit rating and can borrow at 6%. Y is having a triple B credit rating and can borrow at 12%. So X also has to pay money to D and Y also has to pay money to D. And in this payment that is required, what exactly is my uh, nature? Well, both of them have a liability. Both of them have a liability, and now we are doing fair valuation of that liability. X is having a double A credit rating, whereas Y is having a triple B credit rating. Okay. So Y can borrow at 12% and Y can borrow at 12% and X can borrow at 6%. So when I do the working backward, because this will happen after 5 years, okay? So when we do the working of the discounting, etc., how much does it come to? How much does it come to? X will get 374 in today's terms. You just do a discounting from back to front. Okay. And Y is going to get 284. Y is going to get 284. So this is how you will do the what you can say. This is how you are going to do the valuation. Okay. So you are having your own assets, your own liabilities, and to your own liabilities, we are going to do the valuation using these principles. Okay. All right. So fair value of liability reflects non-performance risk. So in our example that we saw, yeah, X getting 374, Y getting 284. Is this the reflection of their credit rating? Answer is absolutely yes. It is. Yes. So therefore, that becomes your understanding. Okay. Transfer restrictions, no adjustment required. Financial liability with demand feature. Fair value not less than the amount payable on demand. Discounted from the first date that the amount could be required to be paid. Okay. All right. So that takes care of fair valuation rules to liability and own equity. Coming to the next one. All right. This one, try for homework. This is valuation of a decommissioning liability. Okay. All right. Can I do offsetting of financial assets and liabilities? Answer is yes. If uh, if you have documented the risk management, information is shared with KMPs and fair value at the end of each reporting period. Okay, so that's it. These are all theoretical, not much of an examination implication. Applying fair values. So this one, just go through it. It's nothing difficult. Okay, it's rather more theoretical. Fair value at initial recognition. See, normally we call it an exit price valuation, but in some case, if it is an exit price value for me, it will be an entry price for somebody else. Okay. So transaction price is nothing but entry price in not, and that equals exit price in normal transactions. Normal transactions. So my exit price, somebody else's entry price will be the same normally. It will be different in the cases of related parties. Sale is under duress or seller is post, different unit of account, and finally, not on principal slash most advantageous market. Yes, all right. So most of the cases, exit price equals entry price. Okay, all right. So that takes care of that. All right. Now, yeah. So these are some of the common disclosures that you are expected to make. Okay, so that's it. You can go through this. Go through this particular question based on what we have discussed. I'll share the solution sheet with you. I could not share it yesterday. Okay, so go through that. It has all our discussions that we have done so far. Any doubts so far in this? Any doubts? Manish, try to solve those questions. That one question, I have already prepared the notes. I need to share these notes with you. I'll share this. But I think once you see this question, you will be in a position to appreciate. Okay, so see, this is the question on Rohini Limited. Please try this out. It becomes critical. Okay, all right. So that is fine. Next, anything else? Anybody else has any doubts on India's 113? No doubt. Okay. So that covers practically everything. The most important one is asset-based valuation. Okay, liability and equity, rare. We cannot see it much. Okay, so that is why you will have to be careful. Okay, so that takes care of Ind AS 113 in totality. Okay, all right, fine. Okay. All right. We do one thing. We take a 10-minute break and then we shall continue with 101. 101 also in 1 hour or so we'll wind up 1 to 1 hour 15 minutes. And that's it. Professional ethics. I'll tell you what you need to do and come so that on Saturday we can cover it up with the remaining topic on conceptual framework. Okay. So a 10-minute break and then we shall continue. Okay. All right. Okay. All right. So, welcome back. We start with Ind AS 101. Fair value measurement, I think it's done. So, we don't have much to go through on that now. So, we come on to Ind AS 101. So, this is a summary. I mean, this is basically I'm drawing from my earlier session notes itself so that we save time instead of me wanting to write. Okay. All right. Now, from an examination perspective, it's not very popular, but it is important from a practical perspective in the sense that uh, we are actually transitioning from the AS regime to the Ind AS regime with the help of this standard. So there are a lot of exceptions, exemptions, simplification in terms of treatments which are given under Ind AS 101. There are a lot of exceptions and exemptions which are given. Now, is it a policy change that I move from AS to Ind AS? Answer is yes. And because it is a policy change, uh, you will be having restatement of the prior years also. You will be having a restatement of the prior years also. That is the reason why the first time adoption, the Ind AS, you have three balance sheets which are presented. The reporting period as at the reporting date, the previous comparative, and the beginning of the earliest reported period. So that is why you are having this particular comparison. Okay. All right. Now, I have to not only change current, but also the previous period numbers also. So the previous period numbers also. Now, when do I actually have to do a convergence to Ind AS? You have to do a transition to Ind AS when the net worth exceeds 250 crores. This is mandatory. Otherwise, voluntarily, you can do it at any point of time. Voluntarily, you can do it at any point of time. Now, the transition is obviously going to be based on the previous periods, that is the net worth that we count as per the AS regime. That will be the basis for applicability of Ind AS. That will be the basis for applicability of Ind AS. Are we okay with this? So this is the fundamental background behind Ind AS 101. Okay. Now, what do we understand by first Ind AS financial statements? These are the statements where entity adopts Ind AS through an explicit and unreserved statement of compliance. What did I say? These are the statements. This is the statements where the entity adopts Ind AS through an explicit and unreserved statement of compliance. Any first time adopter will say that we have complied with all the provisions of all the Ind ASs in our financial statement. This is the statement made by the management. The auditor may find some gaps. For those gaps, he obviously has his auditor's report to fall back. But so it is very common that an auditor may not agree with a particular treatment, but the company will continue with that treatment. Auditor can substantiate his point in his audit report. Okay. So that both these things can exist together. Auditor can put a qualification, at the same time, management can give a explicit, unreserved statement of compliance. Both the things can happen. Okay, so this is the meaning of first time adoption. Okay, I mean, this is the meaning of yes. So first Ind AS financial statements by an explicit and unreserved statement of compliance. Okay, so compliance with all Ind AS is essential. First time adopter entity that presents its first Ind AS financial statements. Opening Ind AS balance sheet balance sheet at the date of transition to Ind AS. What do you mean by date of transition to Ind AS? The beginning of the earliest period. The beginning of the earliest period for which an entity presents full comparative information under Ind AS in the first Ind AS financial statements. So what is your date of transition? Suppose you are required to adopt Ind AS from 1st April X0, then you will be having a comparative X0 X1. So the beginning of the comparative, that is 1420X0, will be the date of transition. It is on this date where you do all entries, all adjustments to your opening reserves, and you recast the opening balance sheet as at 1st April 20X0. And from that period onwards, you will proceed with Ind AS accounting. Okay. All right. First Ind AS reporting period, the latest reporting period covered by an entity's first Ind AS financial statement. So that becomes your first Ind AS reporting period. Okay. XYZ is a BSE listed company having net worth of 100 crores. Has to prepare financial statements from 1st April 20X1. First Ind AS financial statements would be for the period ending 31st March X2. First Ind AS reporting period would be 1st April X1 to 31st March X2. Date of transition 14X0. Opening Ind AS balance sheet also 14X0. First time adopter is XYZ Limited. Is it okay? Yes. The financial statements for the period X0 X1 shall be comparative period for the first Ind AS reporting period. So this is the definition of first Ind AS reporting period. All right. Now, what do you mean by previous gap? The basis of accounting that a first-time adopter used for its statutory reporting requirements immediately before adopting Ind AS. Immediately before adopting Ind AS. उसको हम लोग बोलते हैं first time. We call that as the previous gap. We call that as the previous gap. Are we okay with these basic definitions? Yes. Are we okay with these basic definitions? Yes. Any doubt? No doubts? All right. So now let us proceed further. Let us proceed further. When we move from Ind AS, I mean from AS to Ind AS, when we move from AS to Ind AS, what happens? What happens? In all, four things happen. Okay. Any of these four things will happen. Okay. And this is very, very important. Okay. When we are converging or when we are transitioning from AS to Ind AS, four things can happen. First one is I will have some assets or liabilities which are recognized in accounting standards, but they need to be de-recognized in Ind AS. So there are certain items which were there in AS, but they are de-recognized in Ind AS. For example, proposed dividend, we would recognize it earlier under accounting standards. But in Ind AS, we are recognizing only once the shareholders have approved it. Until then, we don't even make a provision for proposed dividend. So therefore, under AS, it was recognized. This is prior to the amendment. Under Ind AS, it was not required to be shown. So what was recognized needed to get de-recognized under Ind AS. Are we okay with this? Yes. So this is one example. Recognized in AS, but needs to get de-recognized in Ind AS. Number one. Number two, de-recognized in accounting standards, but should be recognized in Ind AS. De-recognized in AS, but should be recognized in Ind AS. Like for example, bills receivable discounted. Bills receivable discounted. What entry did you pass under accounting standards? When you used to get the bills receivable, BR account debit to customers, and then you would go and present that bill to the bank would discount the bill. So you would get bank account debit, discount account debit to bills receivable. So that takes care of your accounting standard treatment. Can I de-recognize this bill receivable under Ind AS? Answer is no. Why can you not de-recognize? Because the liability has not gone from your head. Tomorrow, if your customer fails to honor his bill, The bank will come to you and demand the money from you. So technically, your liability has not vanished. Your liability has not vanished. Okay. So Ind AS de-recognition of bills receivable not permitted. Are we able to follow? Yes. Are we able to understand? Next one, reclassification. Assets we may have to reclassify as investment property. Preference share capital, which you used to show under shareholders funds, will now come under liabilities. Okay. And last one is you are having remeasurement. Last one you could be having is remeasurement. Are we okay with this? So four things. What are the four things? First one, recognized in AS but not recognized in Ind AS. Second one, de-recognized in AS but needs to be recognized in Ind AS. Number three, reclassification, and number four is remeasurement. Any doubts so far? Any doubts? All well? Okay, fine. So let us proceed then. Um, So let us understand with a simple question how this goes about. Okay. Okay. Mathur India Private Limited has to present its first financials under Ind AS for the year ending 31st March 20x3. The transition date is 1st April 20x1. Okay, fine. The following adjustments were made upon transition to Ind AS. The company opted to fair value its land as on the date of transition. The fair value of land as on 1st April was 10 crores. The carrying amount as on 1st April X1 under existing gap was 4.5 crores. So this is a remeasurement. This is a remeasurement. So what is the entry that you are going to pass? The entry that you will be passing is uh, land account debit to opening retained earnings. All these adjustments go to retained earnings. On account of transition, nothing goes to the P&L. Any transition related adjustments that happen, they will all be routed through the retained earnings, none of it through the profit and loss account. So land account debit to opening retained earnings, 5.5 crores, 10 minus 4.5. The company has recognized a provision for proposed dividend of 60 lakhs, related dividend distribution tax of 18 lakhs. So total is 78 lakhs. During the year ended 31st March X1. It was written back as on opening balance sheet date. So this becomes the de-recognition. So entry will be proposed dividend account debit to opening retained earnings 0.78. Are we okay with this? Yes. Next. Next. The company fair values its investments in equity shares on the date of transition. So fair values its investments in equity shares. Increase on account of fair valuation is 75 lakhs. So investment in equity instruments account debit to opening retained earnings 0.75. Yes. Any doubt? All clear till now? Next. The company has equity share capital of 80 crores and redeemable preference share capital of 25 crores. So the redeemable preference share capital, you can go for calling it as the reclassification. So preference share capital equity account debit to preference share capital liability. Reserves and surplus as on 1st April X1 before transition to Ind AS was 95 crores, representing 40 crores of general reserve, and 5 crores of capital reserve acquired out of business combination. Balance is surplus in the retained earnings. The company identified that the preference shares were in nature of financial liabilities. What is the balance of total equity as on 1st April 20x1 after transition to Ind AS? Show reconciliation between total equity uh, as per AS and as per Ind AS to be presented in the opening balance sheet as on 1st April 20x1. Ignore the deferred tax impact. Yes, ignore the deferred tax impact. Come on. I think we have done all the adjustments. Now, only thing that you need to do is you need to put it in a formal solution like presentation. So it starts with this, right? It starts with this. You have equity capital 80, other equity, you have general reserve and capital reserve. Yes, okay, yeah, 40 crores general equity capital 80. So you are having equity capital 80. Redeemable preference capital 25. Reserves and surplus was 95. 40 general reserve. 40 general reserve. Capital reserve 5. Capital reserve 5. Okay. All right. Next. Okay. So this is done. Next, coming to our adjustments, retained earnings as per GAAP 50. Yes, this is basically 95 total minus 95 minus 40 minus 5. So that comes to 50. Transition adjustments, we have remeasured land, we have de-recognized proposed dividend and DDT. We have done a fair valuation of investments. Yes, so your total equity is going to be 182.03. 182.03. Are we okay with this? Are we okay? Any doubts? Yes, all well. Okay, Manish has confirmed. Coming next, question 6 is done. Taken care of. All right. So in addition to this, we have certain specific transitory items. Now, specific transitory items are multiple. Okay, I think we have all in all about 7 or 8. One is ESOPs, then we are having foreign exchange, then we are having PPE, intangible assets, business combinations, compound financial instruments, investment in joint ventures, yeah, government loans below the market rate, measurement of financial instruments, and estimates. So all these things are there. I will try to be very fast in this because there is very less time and we need to complete the chapter. Okay. So all in all, about 7 to 8 additional transitory items are there. Okay. So let us try to understand what it is. So stock options. we will be having three cases of stock options. You would have studied Ind AS 102. Okay. Three cases. The first one is date of transition is 1st April 22 for all the three cases. Grant date 1/4/15. Vesting period 3 years. Exercise 1 year. So therefore, vesting ends on 31st March 18. Exercise period ends on 31st March 2019. So therefore, this is your total, and before it converges, I mean, before the transition to Ind AS, the stock options are already completely, I mean, the tenure pertaining to stock options is finished. You don't have anything else that is left out. So therefore, you don't have to do anything. So in the first scenario, no impact on transition. Okay. Second case, you granted on 1st April 15, vesting period is 5 years. Vesting period is 5 years. Okay. So now you would have passed the entry employee benefit expense account debit to SBP reserve and SBP reserve to share capital. This is what you would have already passed. Okay. Something that you would have already passed. Okay. Now, on transition date, is the vesting complete? Answer is yes. Vesting is complete means what? Employee benefit expenses are already booked. But is the grant date also over? Answer is no. Grant date is not yet over. We still have the exercise period going on. So now, options as per the old regime are calculated, but currently you are still having some, what you can say, currently you are still having the grant period still pending for its closure, and in between the grant period, your Ind AS transition mail has come. Yes. Now, since your Ind AS transition is already happening, here you are having two impacts. First one, the standard says since the expense is already booked, don't do anything in the current period. Just take the existing value of SPP reserve and continue. Just take the existing value of SPP reserve and continue. All right. So that is one thing that you will have to do. Alternatively, you can do a retrospective restatement. And calculate the fair value right from the very beginning. So stock options already vested. First option, don't do anything, continue at current value. That means previous gap value continues, or as a transitionary relief, you can go. The transitionary relief is an option that is there. Alternatively, you can go for fair value restatement right from the very beginning. That means right from 1st April 2015, you can go for the relief. You can go for the restatement. Okay, so these are the two options that you are having. Always remember, any relief granted under Ind AS 101 is more often than not optional. You can go for the complete restatement also. Okay. Case 3, transition date 2022. Options given 1/4/15, vesting period 10 years, exercise period 4 years. So is the vesting period complete by now? Answer is no. Vesting period also is not complete. And therefore, now there is no transition relief. In the third case, there is no transition relief. Why there is no transition relief? Because your employee benefit expenses are yet to be accounted. So वो कैसे होगा? How will that happen? Okay. So based on best available value, restate options to fair value and then compute the EBE for balance period after transition. Is it okay? Yes. Yes. First case, no impact because vesting is done, stock options are granted, nothing is outstanding. Second case, vesting is done, grant date is pending. You can give a transitionary relief, or ultimately what you can do is you can go for a retrospective restatement. Third case, what about the third case? Vesting also is not over, so you need to book the employee benefit expenses. So therefore, there is no transition relief. Based on best available value, restate options to fair value, and then compute the employee benefit expenses for the balance period after transition. Is it okay? Yes. Yes. There is no option here. You will have to take care of it. Okay. Any doubts? Any doubts? No doubts? Yeah. All right. Next. Something very interesting. Okay. Foreign exchange. You had AS11. So under AS11, you would have taken a foreign currency loan. So there was a para 46A, which was there under AS11. Now, what did this para say? It gave you an option. Why? Because there was a very violent exchange rate movement in the years 2010, 2011. That was the time you had this para 46A that came in. Ideally, a foreign currency loan is a monetary item. Yes. Monetary items have to be restated at the closing rate. Yes. The the impact of translation or the impact of restatement would ultimately go and hit the P&L. Yes. So this was the first option that was given. Companies could do this. Alternatively, there were two other options which were given under para 46A. What are those options? First one, if you have a long-term foreign currency borrowing, then the movement, the foreign currency loss that is there, you could accumulate it in a special account, which is known as foreign currency monetary item translation difference account. क्या account? Foreign currency monetary item translation difference account. That means FCMI TDA account. You can park it in that, वो reserve में रहेगा, and then you will charge it off over the tenure of the loan. You will charge it off over the tenure of the loan. This is the first way. The second way is you can. The second option that was given was if you have taken this loan to buy a depreciable asset, then you add this particular foreign currency gain or loss into the asset. Are we okay with this? Yes. Are we okay in this? So you could capitalize it in the value of the asset and depreciate it so that forex gets spread over the life of the asset. So this was the status prior to IND-AS. Now IND-AS has come. Do you think IND-AS has an FCMI TDA option? Answer is no. Do you think, okay. So now in IND-AS, whatever be the choice, your forex gains or losses must always go to the P&L. There you don't have any para 46 age as a treatment. Okay. So now what does the transition position say? The transition position provision says that in respect of existing loan, if FCMI TDA option availed, then you opt for second option. You can continue opting the second option. Okay, accumulating the difference in your FCMI TDA on date of transition, and even there carve out. This is a carve out from IFRS. This is a carve out from IFRS. Are we okay with this? Yes, are we okay? Alternatively, entity can continue to say that I will do it only through the P&L account. That is also perfectly fine. That is also perfectly fine. So, if I talk about Forex gain or loss, previous gap, I went in for the first option, that is taking all my differences to the P&L directly. Is it allowed? Answer is yes. So the second option also will be option one, that is taking to the P&L. Second option, you have option one. That means I'm taking the forex fluctuations to the P&L under the earlier regime. Whereas now I want to go for option two. So on the date of transition, is this allowed? Answer is no. This is not allowed. Next, option two is being followed, para 4646A. That means either in FCMI TDA or in the capital asset you have capitalized. In days 2 says, in days says, I will also go ahead with option 2. Standard says that is allowed. That is allowed because of transition release. Because of transition release. Okay. Alternatively, option 2 under the previous gap, option 2 under the previous gap, para 46 they already availed, and then what is the next one? You want to go for option 1 P&L. That is also accepted. That is also accepted. Okay. Only one thing is not allowed. Previous gap option 1, current gap option 2. That is something which cannot be allowed. That is something which cannot be allowed. Are we okay with this? Yes. Are we okay with this? Yes. Any doubts? All clear? Okay. Now, suppose I have an FCMI TDA balance. What do I do with that? You cannot put it as it is. Okay. You cannot put this as it is. So, therefore, your okay. So, you will have to reset it to 0. You cannot carry forward the values from previous gap as it is. Okay. All right. Now, the next one coming to intangible assets, property, plant, equipment, investment in subsidiary, associate, or uh, subsidiary, associate, or joint venture. So, in this case, you can retrospectively follow Ind AS, so bring forward those costs only as it is, or you can go for deemed cost. Or you can go for deemed cost. What is the deemed cost? Previous gap carrying value. Yes, previous gap carrying value, or you can opt for the fair value on the date of transition. You can opt for fair value on the date of transition. Yes, done. Any of these things will work. Any of these things will work. Okay, all right. Go through these couple of questions for homework. Illustration 12, 13, 8. Okay. Yes. Next. All right. These are all routine entries. All right. Coming next to business combinations. Coming next to business combination. Very critical amendments are there in business. I mean, very critical relief is given under business combination. See, what happens in business combination? Is it different? Is it different from accounting standard 14? Answer is yes. Is it different from accounting standard is it different from accounting standard 21? Is it different from accounting standard 14? Answer is yes. It's different from all of them. Okay. And therefore, we are going to look at how do we do the treatment of business combinations. Okay. Because the moment you opt for retrospective restatement for each, the moment you opt for restatement, you have to go back in time, and each business combination that is there, you will have to do the uh, treatment accordingly. Okay, so therefore, suppose I have the date of transition as 1st April 2021. I have acquired these shares right from the beginning. Okay, and I have optionally convertible debentures on 1st April 2012. Okay, X is the parent of Y. So you will have that particular consolidation that would already be happening. Now, in Ind AS, who is the parent of Y? X is holding 1000 equity shares of Y, but Z is holding 10,000 optionally convertible debentures of Y. So who becomes the owner? Yes, yes. Who becomes the parent under Ind AS? Will X continue to remain the parent or will Z remain the parent? Yes. Obviously, X can no longer be the parent because for the purpose of ascertaining the control, we also look at the presence of potential shares in the capital structure. So therefore, under Ind AS, it is Z who is the parent of it is Z who is the parent of Y, though they do not have the actual shares. They have optionally convertible debentures, and X is the erstwhile parent of Y. X is the erstwhile parent of Y. Now the question is, how do I do the convergence? How do I do the convergence? Okay. Well, you can do the convergence by doing a restatement of all the assets and liabilities depending on from when you want to treat this as a business combination. Number one. Second, you will have to do the workings for the NCI. You will have to do the workings for the NCI. Yes, and finally, you will end up calculating the goodwill. Finally, you will end up calculating the goodwill. Are we okay with this? Yes, sure. Yes, done. So you have two options. First option, no restatement for previous business combination. Or secondly, restate past business combinations with effect from a particular date. From that date onwards, everything has to be restated, including your goodwill, property, plant, equipment, liabilities, investment, assets. Everything has to be restated if you're opting for a past purchases with effect from a particular. Yes, any doubts? No doubt. When I say prior period restatement, assets at fair value, liabilities at fair value, giving net assets at fair value, then your in everything at fair value, then ultimately you get the revised goodwill, which you will plug into your system. Are we okay with this? Are we okay? Yes. So choice is yours. Choice is yours. Okay. Nothing much to be done from our side on that. So what entities do is normally the date of transition is the date they take for the purpose of business combinations. Is the date which they take for the purpose of business combinations. Okay. Next, compound financial instruments like convertible debentures, etc. These are split accounting. These are split accounting. So find the liability and equity component on the date of issue. Find amortized cost on the find amortized cost, all right, on the date of transition. That means right from inception you go on doing the addition of the interest, and then whatever is paid go on doing until you reach the date of transition. Find ledger balance as per previous gap on the date of transition after considering discount, premium on redemption, or yes, or redemption, or coupon payments. Okay. So this is the third step, finding of ledger balance. And fourth step is eliminate liability under previous gap, replace with equity and liability component as per step two. Difference, if any, recognized in retained earnings. Recognized in retained earnings. Yes. Any doubt? Yes. Any doubts? No doubts. So you have to do the restatement. There is no option under compound financial instruments. Okay. There is no option under CFS. Yes. Done. All right. All right. Okay. So financial instruments is done. We saw the impact. Okay. Balance as per gap, amortization. So you can see the entry that is taken. Convertible debentures account debit to liability component to equity component, and this gives you the total amount that should go to the retained earnings, which is the balance. Okay. Yes. Done. Did you understand? This is the transition entry. Yeah. Done. We'll proceed. Then you do the regular amortization of unwinding of discount, and you do the regular accounting. Okay. All right. Now, investment in joint ventures. Under Ind AS 28, we have to do the equity method of accounting. Under accounting standard 27, we used to do proportionate consolidation. That means all assets, liabilities, line by line, we used to do the, what you can say, we used to do the proportionate uh, consolidation. Now, when you are transitioning to Ind AS, proportionate consolidation means each asset, each what you can say, each asset, whatever is there, each liability, what is the proportionate shareholding, in that proportion it will get added there. It will get added there. Okay. Transition to Ind AS would be as under: initial investment on the transition date would be the aggregate value of all assets, liabilities, including proportionate goodwill, to test in investment for impairment. Okay. So now what you are going to do, you are going to create investment in the what you call investment in joint venture, trade payables removed, short-term provisions removed, PPE, long-term loans, trade receivables, other current assets. So all of them you will consider separately to remove, and balancing figure will go to your goodwill. Will go to your goodwill. Are we okay with this? Are we okay with this? So basically, because this entry is necessitated, because there you are doing a line by line addition under accounting standards, but here it is just one to equity. Is it okay? Yes. All right. Next, last two, three items. Government has given a loan below the market rate of interest. Prospective application, record the loan as per previous cap value. Grant not recognized for benefit arising due to below market rate of interest. Okay. No split accounting as per Ind AS 2010. Okay. Next, retrospectively restate. Alternatively, instead of prospective, go to retrospective, recognize the and recalculate the financial liability and grant component based at fair value. Loan amount amortized by as a financial liability and government grant transferred to P&L, deferred government grant, adjustment against cost of the state. Okay, all these things at adjustment against cost of assets. Okay, so all these things you will be doing. Okay, loans below the market rates. All right, so two options: prospective, retrospective. Prospective only from now on, from now on. So you are having the previous cap value substitution that is permitted. All right. Next, measurement of financial instruments. Measurement of financial instruments. If EIR can be computed retrospectively from the date of instrument, from the date of instrument. Okay. If EIR can be computed retrospectively, please restate retrospectively and determine the carrying value as per 109. Okay. If computing old EIR is impracticable, fair value on date of transition to be considered as new carrying value. So choice is yours. Okay. And estimates, since you are restating something which is already audited, the obvious question arises, sir, we got some additional information about certain estimates which we had taken. Do I restate those estimates? Answer is no, because those estimates were made at that point of time. The fact that you are now aware does not change the nomenclature that they were estimates as at that date. So no hindsight benefit in respect of estimates is permitted. So these are the broad categories where you know you will be able to see certain Ind AS 101 related areas. What happens is in Ind AS 101, we typically look for certain exemptions, certain shortcuts, certain areas where we are able to get where we are able to get what we say ease in transitioning from the AS regime to the Ind AS regime. That is what is critical. Okay. Otherwise, if Ind AS 101 was not there, can you imagine what would happen if Ind AS 101 was not there? You would have to do a retrospective restatement for each and every item. For example, you have done business combination. Suppose you have done 5 to 6 business combinations. Then you have to go back in time for each of those business combinations. You will have to apply the Ind AS 103 principles. Then you have to do the Ind AS 110 principle, because from that date you will have to consolidate the profit. Okay, so the task would be extremely cumbersome. The task would be extremely cumbersome. And therefore, we have this particular standard which is drawn from IFRS, drawn from IFRS 1, that if you are adopting the first time, you can have many substitutes permitted. You can have many, what you can say, you can have many substitutes or many shortcomings that are permitted. Is it okay? Yes. Is it okay? Is it fine? Anybody has any doubts? Yeah. All clear? So the purpose of 101 is to simplify the transition. So you have these transition adjustments. Because of lack of time, I'm not able to do it in great detail. I presume that you would have solved the questions based on the sessions that were already available to you. In case you have anything, you can reach out to us. Okay. So this is by and large the major adjustments that you have. In the study material, you have one particular question which is very good as far as transition is concerned. If possible, I want you to try the solving this one question by yourself. Okay, this one, illustration 70. Okay, try solving this one question on transition by yourself. It covers other expenses, provisions, long-term loans and advances, other non-current assets, what it is, current assets receivable in cash, dividend payable, as a result of board meeting, subject to approval of shareholders. Chief CFO has also presented following information. PP consists of a class of assets. However, the fair value of the building is so much. Company wants to adopt fair value revaluation model in respect of property, plant, equipment for the first annual Ind AS financial statements. Fair value of intangible asset is given. Shaurya Limited had acquired 80% its shares. Excel Private Limited few years ago, thereby acquiring the control. Shaurya recognized goodwill as per accounting standards. The excess of consideration paid over net assets, fair value exercise was not done at the time of acquisition. So that is there. Trade receivables include an amount of 20,000 doubtful debts in accordance with previous cap. Now, as per latest estimates, the provision needs to be revised to 25,000. Okay. Then you have given a loan, transaction cost, interest rate, and Ind AS 109. Okay. Next, long-term borrowings. This is loan from government, long-term. Next, under previous gap, the mutual funds were measured at cost or market value, whichever is lower. Under Ind AS, the company designated these investments at FBTPL. So the value of mutual funds is 2 lakh as included in the current investments. However, fair value of mutual fund is 2 lakh 30,000. So fair value is available. You can take that and do the working. Ignore separate calculation of deferred tax. Assume the net deferred tax income to be 50,000 on account of Ind AS transition adjustment. Okay, next one. Requirements: prepare a transition date balance sheet and show necessary explanation for each of the items presented by CFO. Yes, in the form of notes, which may or may not require the adjustment as on the keys in the form as on the date of transition. Yes, so that is why this question is important. It covers almost all the adjustments that we have done. Okay, so please try out this particular question. All right, so that takes care of this is the only major one. Rest are all okay, not so difficult to solve. Okay, so this is the major one. Fine. So that's done. Coming next. All right. Index 101. Yeah. So I think, yep, that's it. Rest, what else is there in Index 101? Let us see. Yeah. Objective we did. First, in days, these terms we have understood. Recognition and measurement principle is done. Mandatory exceptions, voluntary exceptions, carve outs we saw. Appreciate the applicability and non-applicability, that is also done. Okay, so we have been able to kind of zip through the concepts of Index 101. Let me know that if this was okay for you. Okay, now coming to the last topic, that is professional ethics. Okay. What I want from you is just a minute. What I would want from you is, have you guys read the professional ethics? Yes. Have you attended the sessions? Yes. Bolo. Have you read this? It is not the same as the ethics that you normally study in your auditing paper. Okay, although the basic principles, etc., remain the same. In professional ethics, what happens is we are more focused on looking at uh, members in service and what could be the ways and means of them derelicting from their duty, being negligent, and how it should be avoided. So in terms of your examination, they are moving from a regular question answer type to more of a case study type. Okay, that is the ultimate intention that they are looking at. So this ethical code is based on the new ethics, on the new code of ethics, which has become applicable from 1st July 2020. Okay, so that is something that you will have to uh, read. Okay, so you are having Chartered Accountants Act, a brief note on this. You have these schedules, all this first schedule, second schedule, and then first schedule part one, misconduct in relation to chartered accountants in practice, members of the institute in service, misconduct in relation to members of the institute generally, other misconduct in relation to members of the institute generally. And now it is in the second schedule, misconduct in relation to chartered accountants in practice, professional misconduct in relation to members of the institute, other misconduct in relation to members of the institute generally. Okay, so these are the broad heads which you are already aware of. This is something that you would have done most of it in your auditing paper. That you would have done most of it in your auditing paper, which is what they have given. Okay. All right. Now, so what you are having is the five fundamental principles: integrity, objectivity, professional competence, confidentiality, and professional behavior. So these are the five things that you will have to remember. You cannot afford to forget. And all your queries, all your questions will be on the basis of this particular what you say nomenclature or this particular hierarchy. So in your exam, whenever you get a case study, without fail, do not forget to put the point of do not forget to put any of these 5 points based on the question that is there, because you have to exhibit your knowledge to the examiner. Okay, so that is done. Object, yeah, so you can look at some of these questions. It's largely case study based, but just for us to understand what are the possible uh, breach of professional ethics that members in service can also suffer from. What can they suffer from? Okay. All right. Fine. Many times, what would happen is the member in service is compelled to give some information so to regulatory authorities, etc. So what are the uh, what you can say, what are the repercussions of that? If it is statutory, is it fine to give? If not, what to do? Okay, so all these things come and form a part of the discussion that we will have on Saturday. Okay. All right. The key points that you have to remember when you get a question on professional ethics is that you have to understand what is the motive behind the member to avoid following the rules. Like, for example, there could be a threat to his job. The management would have said, if you don't do such and such thing, then we are going to terminate your employment. Or the second scenario could be that, so these are the kind of tactics or these are the kind of pressures that management can put upon the entity, upon the person. Second is earnings management comes voluntarily because you are having certain indicators for your performance, which is ultimately going to decide the incentives, your future salaries, etc. Now, obviously, if the person who is what you say, if the person is having a requirement of those incentives, then he will find any ways to creatively do the dressing of his financial statements. Yes, like for example, he could treat revenue expense as a capital expense and take it to the what you can say, take it to the capital item, removing it from the P&L, thereby enhancing the EBITDA. So ultimately, there are various numerous ways in which you are going to manage the earnings. Okay, based on EBITDA or turnover being a basis for revenue. Okay, for being the basis for increments, or your material margin being the basis for increments. Okay, or salary cost as a percentage of revenue. That is one more indicator. So all these things is something that you will have to look into when you get a question on professional ethics, because your answer has to be very very holistic in nature. You just cannot say yes, there is a breach of there is a breach and it becomes professional misconduct. You just cannot say that and come out. You need to be very elaborate in your answers. You need to be very elaborate in your answer and uh, communicate well in your examination paper. Okay, only then it makes sense to approach this chapter with the right amount of hard work that it deserves. Okay, all right. Next, all right, it's done. All right, fine. So that's it. So can you read this for me and come professional ethics? Because on Saturday, what are we having? Professional ethics and conceptual framework. So conceptual framework will take slightly more time. And then if time permits, in the next class, I will try to pull up some questions on Ind AS 101. Okay, if we have the time. But as of now, will you read this and come? Yeah. Yes. Any other doubts? Anybody? Any other doubts? Anything else? Yes, Manish. Nobody else is watching. Kushi. Yeah. All right. Hardly any student. All right. So go through that, and then once we are done with it, I think, yeah, the next Saturday happens to be your last class, I suppose, for the November 2024 attempt. Okay. So, okay. So, I'll share these notes on Index 101 so you can, have a reference of all these adjustments in one place. Have you received the notes pertaining to the earlier sessions that I have taken? Yeah. You were able to download the notes, Manish? Okay. I think nobody is there. Not checked, yes. But before that, were you able to download? We did Index 12, we did Index 19, we did those standards, right? So that was uploaded at that point of time. So were you able to access that? Index 33, Index 108. Okay, 27 notes. Okay, then maybe they would upload it today. Let us see. Okay. So fine, I'll ensure that you get all your notes by the time it is Saturday. Okay, by Saturday you should have all the notes. Okay. All right, fine then. So with this, we conclude our session for today, and then we shall meet up on Saturday morning. Yeah, Saturday morning we shall have a session, and we shall close whatever is there. All right, fine. So that's it from my side. Anything else? Nothing else. Okay. All right then. So see you guys on Saturday. Okay. All right. Session concluded. Yes. Thanks.